26%, 33%. Those are the distribution rates on 2 crypto income ETFs right now. And if you're retired or close to it, those numbers probably stopped you mid-scroll. Here's what this video is going to do for you. By the end, you'll understand exactly what those percentages really mean. You'll know what financial advisors actually recommend for crypto in retirement, and you'll have a clear, simple framework to decide if these funds belong anywhere in your portfolio. There's one number hiding inside these funds that changes everything. Most people never see it, and once you do, you'll look at every high-yield ETF differently. We'll get there. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Okay, let's start with what these funds actually are. BTCI is the NEOS Bitcoin High Income ETF. It launched in October 2024. Right now, its NAV sits around $27.91, and it holds just over $1 billion in assets. The expense ratio is 0.99%. NEHI is the NEOS Ethereum High Income ETF, much newer, launched December 2025. That's only about 7 months old. NAV is around $23.49, with roughly $63 million in assets. Expense ratio is 0.98%. Here's how they work. Both funds hold the actual crypto, Bitcoin ETPs for BTCI, iShares Ethereum Trust for NEHI, plus a large chunk of U.S. Treasury bills as collateral. Then they sell call options on that crypto to collect premium. That premium becomes your distribution. The reason those yields are so high, crypto is wildly volatile. In the options world, more volatility means fatter premiums. Ethereum swings even harder than Bitcoin, and that's why NEHI pays 33% while BTCI pays 26%. But here's the thing, these are not traditional dividend funds. They're options income strategies sitting on top of one of the most volatile asset classes on the planet, and that distinction matters, especially if you're counting on them for retirement income. Before we go further, do you currently have any crypto exposure in your retirement portfolio, even 1%? Or are you sitting at 0? I genuinely want to know. Now you know what these funds are and how they generate those big numbers, but there are 3 myths floating around about BTCI and NEHI, and if you're making decisions based on any of them, it could cost you. Let's break them down one at a time. Myth number 1. Advisors say load up. Here's the myth. Financial advisors are telling retirees to put serious money into crypto income ETFs like BTCI and NEHI. The bigger the position, the more income. Here's the truth. Advisors do say crypto shouldn't be 0 in your portfolio, but what they actually recommend is way smaller than most people assume. A survey from the Digital Assets Council of Financial Professionals found that among advisors who recommend crypto, 30% suggest just 2% of your total portfolio. Another 20% suggest 5%. And among advisors planning to recommend crypto for the first time, 90% intend to keep it between 1% and 5%. Let me put real names to this. Financial planner Mike Hunsberger recommends 3 to 5%. Michael Reynolds recommends 1%. Jason Gilbert says under 5%, and he specifically recommends low-fee spot Bitcoin ETFs like IBIT, not high-yield income products like BTCI, nearly a full percent. So, advisors do say yes to crypto, but what they mean by yes is very different from what you might expect. Now you know what the experts actually recommend, but here's the next question. Even with a small position, does the income from these funds protect you when crypto crashes? Let's look at the data. Myth number 2. The income cushions the fall. Here's the myth. The high distributions from BTCI and NEHI smooth out the volatility, so even when Bitcoin drops, you're still collecting income, you're protected. Here's the truth. These funds fall almost exactly as hard as the underlying crypto. The income barely moves the needle. Over the last 6 months, BTCI's NAV dropped 30.33%. In that same window, the S&P Bitcoin Index dropped 32.93%. So the protection from all those option premiums? About 2.5 percentage points. On a 30+% crash? That's not a cushion, that's a rounding error.
NEHI is worse, down over 43% since it launched, nearly identical to Ethereum's decline. But here's what really matters if you're in retirement. The distributions are shrinking too. BTCI paid $1.57 per share in January 2025. By June 2026, that dropped to 65 cents. That's a 58% cut to your monthly check. NEHI went from $1.51 to 69 cents in just 6 months, down 54%. Think about what that means. Your account value is falling, your monthly payments are shrinking, and if you need that income for groceries, utilities, or insurance premiums, you're locked in. You're selling into the decline. That is the definition of sequence of returns risk, and for retirees drawing income, it's the most dangerous thing out there. Now let me be clear, I'm not saying Bitcoin won't recover. It might, it has before. But here's the question most people never ask themselves. Can you afford to wait 3 to 5 years for a recovery when you're pulling income from a shrinking bucket every single month? At 32, you've got decades of runway. At 62, that math looks completely different. Since BTCI launched in October 2024, its total return, that's with every distribution reinvested, is still negative 12.7%. The income did not save you. Smart retirees need to understand that reality going in. So the funds crash with crypto and the income shrinks when you need it most. But here's the myth that catches more people than the other two combined. Once you see this, you'll never look at a high-yield ETF the same way again. Myth number 3, 26% is real income. Here's the myth. BTCI's 26% distribution rate means you're earning 26% on your money every year. NEHI's 33% means even more. Here's the truth. The vast majority of that distribution is not income, it's return of capital. The fund is handing you back your own money and calling it a payment. Here's the number that proves it. Every fund reports something called a 30-day SEC yield. That's the actual investment income the fund generates, not the distribution rate, the real income. BTCI's 30-day SEC yield, just 1.48%. NEHI's, just 1.98%. Now compare that to the distribution rates. BTCI, 26.72% distribution rate, but only 1.48 actual yield. NEHI, 32.99% distribution rate, but only 1.98 actual yield. That gap, almost entirely return of capital. NEOS themselves reported that approximately 95% of NEHI's most recent distribution was classified as return of capital. 95%. Let that land for a second. So what does return of capital actually mean for your money? Every ROC distribution reduces your cost basis. Say you bought in at $40 a share. After $10 in ROC distributions, your cost basis is now $30. When you sell, you owe taxes on a bigger gain, or you lose a bigger deduction on the loss. At these distribution rates, your cost basis could hit zero in roughly 3 to 4 years. After that, every single distribution becomes a taxable capital gain. For comparison, a fund like SCHD has an SEC yield around 3.5%, and that's almost entirely real qualified dividends from real company profits, real income from real businesses. That is a very different animal. Quick question before we move on. Before this video, did you know the difference between a distribution rate and an SEC yield? Yes or no, drop it in the comments. I read every single one. This is the one thing that separates informed investors from everyone else. So now you know what these funds actually are, you know what advisors really recommend, and you know what those headline numbers actually mean behind the label. The question is, does all of this mean you should avoid them completely? Not necessarily. Here's the Smart Retiree's Crypto Playbook. If you've made it this far, you understand these funds better than 90% of the people looking at them, and that understanding is exactly what lets you make a smart decision instead of an emotional one.
Here's the framework. Step 1. Build your core first. Your retirement income portfolio should be anchored by lower volatility, diversified holdings, broad market funds, dividend growth ETFs, high-quality bonds, maybe covered call funds on major indexes like the S&P 500 or NASDAQ. That core covers your essential expenses, no exceptions. Step 2. Only after that core is solid do you consider a crypto satellite. Cap your total crypto exposure at 1 to 5% of your portfolio, the lower end if you're already drawing income, the higher end if you're still working and have time. Size it so a total loss, and with crypto that's not impossible, would not change your retirement. Between the two funds, BTCI is far more established, over $1 billion in assets and nearly 2 years of performance data. NEHI has just $63 million and only 7 months of history. That small size means higher closure risk. If NEHI gets shut down, you're forced to sell on the issuer's timetable, not yours. And here's one more thing worth knowing. A simple spot Bitcoin ETF like IBIT charges 0.25%. BTCI charges 0.99%. On a $15,000 position, that's $37 a year versus $149. Over 10 years, that gap compounds, and the total return from both has been nearly identical. If you do buy, hold them in a Roth or traditional IRA. That eliminates the return of capital cost basis headache entirely. In a taxable account, those shrinking cost basis numbers can eventually push you over IRMA thresholds, and that means higher Medicare premiums that eat into the very income you were trying to earn. Smart retirees think about that before they click buy. Here's the line I want you to remember. The number on the label is not the number in your pocket. 26% on a fact sheet is not 26% income. Understand that one sentence and you're ahead of the crowd. If you know someone, a friend, a spouse, a neighbor, who's been eyeing high-yield crypto ETFs for retirement income, share this video with them right now. It could save them from a very expensive surprise. Here's my question for you. If you're holding BTCI or NEHI right now, what percentage of your portfolio is it? And after watching this video, are you comfortable with that number? Let me know in the comments. If you're serious about building real income from your investments and you want to stay ahead of the numbers that actually matter, subscribe to this channel. We break down the facts so you can make the right call.